Welcome to Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. We believe wise investing starts with a plan, your plan. And your investments may have merit, and they may have relevance to a time and a place, but this all really depends on you, your objectives, and your goals. My name is Seth Cressman. I'm here with Ben Brayshaw and John Ryder. We're all planners and partners with Brayshaw Financial Group. Good morning, guys.
Good morning, Seth.
Good morning, Seth.
And good morning, Ben.
Good morning, John.
You guys can't help yourselves. You always have to get me started on a laugh, and
We're
I
gonna
love
throw
that
you
about
off.
you.
We're gonna throw you off.
Now that I think about it,
Seth.
I don't know that I really do say good morning to you.
We don't. We never
Maybe
do.
That's a subconscious thing.
I think that's what it is. That's what it is. We would rather just.
Well, we're always willing to try something new here.
That
And
is
even live and on air, it doesn't matter. We're going to go for it. So we're glad you're listening to Money on Tap. And if you are looking to sit down with an advisor and start making some of the right steps towards your financial goals, we welcome the opportunity to do that with you. And you can reach out to us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook, 3D Investing. So today, we're going to be taking a look at being a little better prepared when the markets drop and some good practical things to consider. So we live in a world where it's not even probable, it's likely to see big drops in the equity markets. But before we go into that, it's time for Money in the News.
You know, guys, if we were sitting down right now having coffee, we would be spending time talking about the precipitous plunge we had in the markets yesterday.
Well, I am sitting down right now having coffee.
I'm not sharing coffee, but Ben, I think you are. But we are definitely going to be spending some time today talking about what happened in the markets. But before we do that, I just want to spend just a little bit of time talking about the Money in the News article that we have that talks about a New Hampshire woman who says she has a Powerball ticket for $559 million. She wants a court order to allow her to stay anonymous. So basically what she did, she signed over the ticket with her own name, and now lottery officials are telling her that this has to be public information. Now, I don't know about you, Seth, but if you were kind of just going shopping with someone on a regular day basis and all of a sudden you see this lady pull up in a Bentley and she's doing her shopping, you might think that that's the person that won the lottery. Well, this lady does not want that to happen to her. And kind of interesting here. And she, in fact, lottery officials, they're going to force her to come out and to actually say who she is. And we don't know what town she's from, but everyone around here is speculating in the small town, New Hampshire area that we're in. Could it be your neighbor? Could it be the person across the street, the person you work with? I don't know. But it's kind of exciting for people from New Hampshire.
Yeah. Well, if she has a name like Jane Smith,
yes.
I was going to say Doe, but I don't know, something out there that's not super irregular. A, she might be able to get away with it, and two, I think the rolling up to do some grocery shopping and the Bentley, that might be the first piece that I would kind of set aside. Just keep the Corolla. Let's be happy with whatever we're still driving, and maybe it'll just kind of slide under the radar.
Hey, so I saw this article on Fox News, and at Fox News they were talking about how lottery winners do want to remain anonymous for a very good reason. So this one here, obviously this New Hampshire one is a big one, but it says here in the Fox News article, publicity brings significant apparent risk to lottery winners. 2 years ago, a Georgia forklift operator who won $434,272 in a lottery was executed in his home by several masked robbers as he pleaded for his life. Get this, 2012, a 46-year-old Chicago man was poisoned with cyanide the day after he won a $1 million lottery prize. While family members were suspected in the death, none have ever been charged, and the case remains unsolved. In Illinois, this is another case in Illinois. I don't know, Illinois has got some bad raps against them, but in Illinois in 2005...
You spent some time over there, didn't you, John?
I have spent some time in Illinois. In-laws are from there. I spent a lot of time in Illinois, absolutely. So if I win the lottery, I'm not going there. This guy won $20 million prize in 2005. He was murdered by his sister-in-law and her boyfriend. So there are some
Well,
apparent risks if you win the lottery. I mean, it sounds kind of negative,
like
but
that's a close circle of, like, you're talking about, friends, family.
You're talking Rhode Island. You got Rhode Island mob, Chicago mob. I mean, John, you a connected man.
I'm in deep. I am in deep. That's all I'm going to say about it. All right, just forget about it, Ben. Forget about it.
It's sometimes
Keep your
you get what
enemies
you don't.
close and keep your family closer.
Yes.
Well, not in those cases, man. Those
No.
are some bad situations for sure.
Wow.
So
That is
anyways,
so
it's kind
sad.
of interesting how the law works. So I guess if you're going to win the lottery, and if you sign the back of that ticket, now this woman wished that she had gone to an estate planning lawyer before, because basically they're going to force her to actually reveal who she is. Interesting though, last year, actually 2 years ago, in 2016, we had a New Hampshire family that won $487 million. They were able to remain anonymous because they went to their lawyer and they had their trust that actually claimed the prize, and so it kind of worked out well for them. So again, I don't think it was Ben. But someone won that $487 million and no one knows about it. Or at least I don't.
Yeah.
That's a great way to do it.
For sure.
Well, now that we're all prepped on our lottery winning opportunities, so when one of us
And none of
wins-
us play it. That's the funny thing. None of us play the lottery. I don't know if I've ever bought a lottery ticket. I think one time I did for someone. It wasn't me. I think I was buying it for a boss of mine or something years and years and years ago. When I was 16, 17 years old, and they asked me to go when I bought something else from the store to buy them a ticket. I don't buy lottery tickets, so it's definitely not me. So
Well, I remember splitting
Yesterday.
$1. I remember I was in college. I remember splitting $1 lottery ticket with my brother, and as kind of a joke for some of like the largest, at that time, megabucks thing.
Yeah,
in,
yeah.
I don't know if it was federal or state or whatever. And we spent like an hour or two talking about all the things we would do with the money. I was like,
I thought
Time
maybe
well
that
spent.
was like a testament to the ramen budget that you were on as well.
yeah, probably exactly.
I would buy filet mignon instead of these
I would
ramen
definitely
noodles.
not be eating noodles right now.
Oh, that's funny. So anyways, let's get to some more important and more relevant news. And this is based upon a February 5th article about the stock market plunging. In fact, it says that the headline is "Why the Stock Market Plunged Today." So, as we all know, listening now, the Dow Jones Industrials tumbled more than 1,500 points at one point on Monday, and it ended up down 1175.
Yeah.
But the drop in the Dow was bad enough during most of the trading day, but the dive happened right around 240. They call it one of these flash crash type of things that happened in 2010. And here's the interesting thing, though, guys. From what I'm seeing and what I'm reading and everything that I'm hearing, this was not about the fundamentals in the markets. The fundamentals, from what I can see, are very strong. Look, we have jobs growth. We have unemployment down. We have tax cuts that are here and that are coming, and people are going to see real live money in their paycheck. We see a lot of things that are good. So what's going on?
Well, the stock market's all over the place. So we were, I was looking at the market the other day and, watching it tumble on Friday, then, tumble even more on Monday.
666 points, that
And
devilish
swung
number.
900 points already looking at it now. And it's it's got all over the place. I mean, I think the thing is that you have to break it down to its core, right? I mean, at the end of the day, we have seen significant growth since January 1st. That's not unprecedented, but, to the point where, hey, people are like, I already made the return I want to do for the whole year. I might as well just cash out and see what happens.
Sure.
And you're right about the fundamentals, and I think we're going to get into that. But across the board, this was not an institutional sell-off either. So that's a big deal inside of that. Now, what happens?
What do you mean by what do you mean by that, Ben? When you say it's not an institutional sell-off?
Well, when you're looking at
obviously there are people selling off.
Yeah, so I mean, when you look at institutional sell-offs from either big companies or hedge fund companies and so forth, when they start looking at it saying, hey, listen, we need to get out, this was not a huge, you can see those exits and they're tumble like this, but this is not that kind of scenario. And there was a lot of electronic trading that did occur automatically with margin calls and all sorts of
automatic
or 50-day
limits.
moving average. We dropped below the 50-day moving average. Boom, people have those set up. So there's different pieces that people set up automatically to protect their accounts. And a lot of this tumbling, it's a snowball effect. And sometimes it's intentional and sometimes it's not. And but yesterday, when the market was tumbling, we had people buying. We had people saying, "Hey, listen, this is an opportunity. I just made money. I'm going to go make more money."
Absolutely. There's a guy named Joe Lavorna. He's the chief economist for the Americas as Natixis. He says, if you don't think there's inflation and you don't think the Fed's going to be as aggressive as the hawks would have you think, this equity sell-off should be bought. He's not concerned. We're not concerned about this big shift in the market.
Pullbacks are completely common. I mean, this happens all the time in the history of our market cycles. And in an average, there are typically pullbacks in the range of 5 to 10%, with the recovery lasting around a month. But we haven't seen a 3% correction in 445 days, which is the longest run that we have in history. If you look in the S&P 500, it was down 2.12 on Friday, but year to date, we're still up. So, I mean, there's really, this is a very normal occurrence, but it's just been so long sometimes that since we've seen something like that, sometimes, you know what I mean, where you haven't seen something for a while, so it's like now it becomes something that you pay attention to.
Seth, I heard something interesting the other day. When we had that, as I referred to it earlier, the devilish drop of 666 points, I heard an interesting stat where they said that was the sixth largest decline as far as the points going down. So as far as the points going down, that was the sixth largest drop in history. However, it was the 607th largest percentage drop. So, I mean, as far as a percentage, yes. I mean, really, it's a whole different ballgame than it was years ago when we were working at our desks, 15, 20 years ago. So
right. And trades are managed so differently now
Absolutely.
than they were even, 10 years ago. So it's, I mean, part of the automation that Ben was kind of talking about and mentioning is some of these stops that people have and levers that are just automated when market volatility happens. There's ways to be in and out of the market that you don't have to be sitting there with your finger on the button every day. It'll move. It'll happen.
The last page of the article says this. It says the Dow has soared more than 40% since Donald Trump's election, a period that included an impressive 20% rise in the S&P for 2017 and the fastest start ever to a year in 2018. The market simply did not take into account that you can't go up like this that long, says an analyst, Yoshimaka, his name is. And then Richard Bernstein says this, who is a CEO of Richard Bernstein Advisors. The key thing that I think people keep in mind here is that the market moves a lot very quickly. It doesn't mean fundamentals are changing that quickly. What you are seeing is a recalibration among investors that we actually are in a late cycle environment.
I think every time you look at this market from a day by day, second by second purchase, it's like, it's the racetrack theory. I mean, everyone tells you about the horse they're winning on. They don't tell you about the horse they lost on.
Tell you about the winners, not the losers.
Yeah. And it's like, they tell you as soon as you hear about a stock, right? You go look at the stock. It's going up. It's up. It's up. It's up. As soon as you buy it, what happens?
Flash crash.
And like everyone else is listening to this saying, yeah, that's exactly what happens. You're not alone. I think that's the thing. And when we look at things as individual seconds and individual mile markers almost, we fail to miss the 30,000-foot view, that kind of looking down global perspective to say what makes it. So when we say fundamentals, kind of some of that jargon we have in our industry, the fundamentals are all the different pieces that say, hey, we're building a base on realistic opportunity for these companies to make money, right? So we buy investments, we buy stocks in the belief that that company's going to do well, make money, be profitable, and either pay a dividend or have some sort of growth experience which is going to make their company more valuable, which makes my shares that I own potentially more valuable. And that is the basis of owning equities and getting into that space. But then you have this whole emotional scenario. And that's what tides everything. Because when we talk fundamentals are in line, and we're gonna go through that.
You're listening to Money on Tap, and you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook at 3D Investing. We're going to take a quick break. We'll be right back.
On today's Cliff Notes edition of Money on Tap, John Ryder explains the tax advantages of the Roth IRA.
A Roth IRA is really a special retirement account that you can fund with post-tax income, so you can't deduct those contributions that you make into it. But once you have done this, all future withdrawals that you take from that Roth IRA are tax-free. That's a big point, because if you think about it, there are regular IRAs you can participate in. We call them traditional IRAs, and you're able to put so much money into those every year, but you get a tax break for doing that. So that sounds really good, and you might say, well, why would you ever recommend a Roth IRA when I can actually get a tax break for putting the money in now? Well, if you want a tax break later on, and that's what we're talking about here, a Roth IRA can be a very valuable tool for you to have. So understand, no upfront tax deduction for Roth IRA contributions, as there is with a traditional. But on the other hand, Roth distributions are tax-free when you follow the rules. And because every penny that you stash into a Roth IRA is your money, it's not a tax-subsidized gift from Uncle Sam, you can tap your contributions anytime, tax-free and penalty-free.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Seth, Ben, and John.
Welcome back. You're listening to Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now, today we are talking about being prepared, being better prepared for market drops. And, we talk a lot about this throughout many of our shows. Right now, it's kind of an appropriate topic because of what we've seen happen in the markets. Regardless of that, we're going to talk a little bit about some of the conversations or some of the onboarding conversations I think that we have with our clients as we get prepared to help them move through different times in their investing, different times in their retirement, different times that their money is going to be used for different purposes. What does that all mean? And how do we understand how to sit back and be able to ride through some of the hiccups, some of the bumps as we're moving through these market cycles?
Seth, we're going to be talking about diversification. We're going to say that word a lot of times. If I get a dime for every time we say diversification in the show, I'm going to end up with some money. Not as much as the lottery winnings, but I'm going to have some money. The issue here, though, is diversification. And I think it's very, very important for people to understand how diversification works, because these are the conversations that we're having with our clients every time we sit down, diversifying our assets and doing it in the best way possible. I think no show about diversification would be complete without talking about what happened at Enron years and years ago. Very, very bright people working for Enron in the higher echelons, making millions of dollars a year, some of these guys, and they had all of their money sitting in Enron stock, all of it, which you say, well, how can that happen? How can it happen that we have all of our money in one place? Well, these guys did. They had several $1 million in Enron stock, and all of a sudden they wake up one morning and there's $15,000 worth of Enron stock over a few days. How does that happen?
You know, I think one of the biggest problems is people don't understand. When we had a client, just becoming a client really, and in our office the other day, and they own a significant amount of one stock that they got from the company they work for, and I'm just thinking about, and we talked to him, he's like, you know what, I've sold a bunch of it because I know I shouldn't have that much, and he still knows he shouldn't have that much, but he got it from the company, so it wasn't like he went out and purchased it. So I think that's, people generally understand diversification. If you had $1 million, you're not going to put $1 million in just one company. They get it generically, but sometimes they don't understand kind of the levels of diversification. So it's not just sometimes buying lots of different stocks, right? It could be, allocating some funds at the bank. It could be looking at bonds. It could be looking at any sort of type of real estate, you name it. Diversification based on your risk tolerance and your needs, it's something that people do not really have a strong handle on that. And like what happened with, Wells Fargo, the drop that they had.
Yeah, just yesterday, down 9.2%. Yeah.
Boom. Fed comes in. We're gonna spank you. You've been naughty.
Yes, that's right.
And sorry. And then boom, you lose 10% of your money. And I know Warren Buffett has been a huge Wells Fargo champion.
Yeah.
I mean, he has loved that bank.
Side note, he just lost $5 billion yesterday. Just so everyone knows, in case anyone's concerned about their own portfolio losses, Warren Buffett lost $5 billion yesterday.
Talk about moving the needle.
Yeah.
Jeez.
Well,
oh, my God.
So there was a $4 trillion worldwide global loss yesterday in the markets. I thought it was interesting. Asia was down, 5-6%, but Europe didn't suffer that bad.
Not as
I mean,
badly.
it was like 2.5%, under 3%. So I thought that was an interesting perspective on where Europe is and how they're anticipating this. Again, it comes down to fundamentals.
So number one, folks, diversify across asset classes. The most common way to diversify according to asset classes is, hey, there's a lot of different ways you can go. You could invest in stocks, bonds, property, cash, commodities, whatever it may be. But what you want to do is you want to have an asset allocation strategy so that you're controlling the level of risk. And just very simply to say this, let's say that you're a Wells Fargo employee. And let's say that you are given Wells Fargo stock and that you've bought a lot of Wells Fargo stock over the years. If you have all of your money in Wells Fargo stock, well, that can be a good thing when things are going up. But when things go down like yesterday, that can hurt. And so just diversifying and say, well, I don't want to have all Wells Fargo. Maybe I'll have some Coca-Cola in there. Maybe I'll have some Equifax in there. Yeah. Maybe I'll have some General Motors. It doesn't matter. Diversifying is just simply saying, I'm not going to have all of the same thing. I'm going to have some different classes, and maybe not just financial stocks either. Maybe it's important to have some utility stocks in there as well. Maybe it's important to have some general cyclical stocks, Johnson & Johnson, that type of thing. Not that I'm recommending any of those. I'm just saying having several different asset classes is important.
I think we're trying to be as generic as possible to try to give people a perspective. But I think what ends up happening is that we have so many people out there that are trying to invest for themselves, that are trying to step into this void of, I don't know what I'm doing, and I just need to add a bunch of stocks. And they might hear John and say, oh, I'll buy some of that too. Some of these stocks I wouldn't even buy. I wouldn't put it in my own portfolio. Depending on where they're at, it doesn't mean that they're a bad company. It doesn't mean that they may not be profitable in the future. It may not be that I missed something inside any research. It's just that you need to know. You just need to know what you're buying and why you're buying it. And you need to have a time horizon inside that. So that investment objective that you have in why you bought a stock, I was listening to one commentator who was saying, he recommended Wells Fargo under $60.
Okay.
$60 a share.
Yeah.
It's trading under $60 a share. And the person was saying, well, why wouldn't you just say you recommend it at this price? He's like, well, it was kind of like he was bouncing around on everything. But I'm not in Wells Fargo, and I don't have any plans on buying it. So when you start really breaking down the different opportunities that are out there, there's a zillion of them, and knowing what's the right one as an individual investor, if you're out there doing this yourself, is really almost a daunting task at the very least, and that's where help comes in.
Yeah. So Wells Fargo would be under a classification of financials, right? That's one of the ways that we broad classification of segments of investments. That's how that would line up. There's so many different companies in there, or there's even ways to just buy into those sectors to create different levels of diversification. One of the things that I was kind of thinking about when we were talking about this piece, and one of the things I love to do with people is to try to get them into the room. Have you ever been in that room, in that conversation where there's the group of people and they're talking about I always call it the water cooler,
yes,
right? Where
yes.
they're talking about whatever the topic is that I don't know. Let's say they're talking about the gym and their favorite exercise that they do at the gym. And you know what? I'm just not into it. I have no experience in this, and I have nothing to add. And I'm just kind of standing outside of the circle, like, I'll get my glass of water and I'll go back to my desk or something. That's kind of the experience sometimes I feel like we have in these conversations in our offices with people. Is maybe one person's on board and they're maybe a little bit more of the financial person bringing the conversation along, and the other person's just like, gosh, get me out of this office, or at least they have good coffee.
Yeah.
But how do we bring people into the conversation, into the room? And one of the things that comes up with just these common tools and instruments that we're using is a misunderstanding around them. Like, for instance, like there's mutual funds, there's index funds, right? There's these ETFs. These are some of these vehicles, and somebody might think, well, I've got mutual funds and I've got ETFs. I'm diversified. And it's like, oh, well, but those are both sector funds that are the same sector, and that would not be a diversification. It wouldn't matter that the instrument is different.
Yeah, they might own a financially focused on each end, not even understand. I know.
Well, that's why we kind of go into the second area of diversification that we're talking about, asset class variance, meaning that you can invest in equities, but you know what? There's large companies you can invest in. There's medium-sized companies you can invest in. There's small capitalization companies that you can invest in. So making sure that you just don't have everything all the same, I think, is the big part that we want to stress.
One of the things that I've seen, and I know you all have seen it too, and it's people own a lot of different types of instruments, and when you do the breakdown of what they own in the different instruments, like they look at their 401k and they own all these different funds and so forth, and then you actually see what the underlying holdings of those things are. You overlay them. Sometimes they're over diversified, and then they call you and they say, "Hey, I want to buy XYZ stock," and you're like, "Well, hold on a second. You're already." Based on everything else you own, you have a disparity of, a 10% exposure in one stock now.
Guys, we have a great software that we use when we're working with our clients, and we want to see if there's layering there, because we often see that. Yeah. So you'll see people that might have maybe several even different mutual funds that have a lot of the same core holdings. And I remember that was a big issue years ago when it came to mutual fund. They call it truth in labeling, because I remember one particular fund company based out of Boston here that had a lot of very high flying funds, and they did very, very well. But their top 5 or 6 funds all had the same or very, very similar holdings. And so when those funds did well, they went up the charts back in 97, 98, 99. But when things dove down, well, they dove down to all of them.
And this is where when you don't have experience in this area, this is where you need someone's help, is just understanding it. This is what planning does, is we break down, hey, this is what you actually own. This is what the risk you're actually taking. This is the time horizon you should expect to reap any reward from something like this. And we have been fortunate. 2008 is still pretty fresh in people's minds. And
becoming more fresh every day, right?
Yeah, and I think with this recent plunge, this flash crash that we're having, which is, like, again, when you look at the fundamentals, it's not a institutionally driven crash. That means it's the people who are very aware of 2008. These are the people who set up markers to sell off at different times, like some of the electronic markers that we're collecting either on margin. So people are overexposed again on margin. So they're borrowing money to buy more stock with the stock that they already own. So they were borrowing money off the stock they had. So that was one technical scenario that caused a little bit of a drop. Then the 50-day moving average is another technical scenario. They drop below that. So all these things, all these electronic triggers, and what we mean by that is people said, hey, you know what? Here's my portfolio, and if we ever drop below this marker, I just want you to sell it. I want you to sell this holding, this account, this whatever. And so as things happen, that tumbling just picked up speed and speed and more speed and more speed. And some people might have a 100-day moving average sell-off. So as you keep going through that process, it's something that's complicated and so forth. So anyways, turn it over to you, Seth.
Good points. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. We're going to take a quick break. We'll be right back.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, Give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
Ben, John, and Seth explain why it's important for the investor to beware, even when it sounds legitimate, which was the case with Bernie Madoff and the now well-known Ponzi schemes. That's today on our Cliff Notes edition of Money on Tap, as Ben begins by describing what the fraudulent claim looks like.
Someone's taking your money in, showing you a potential value to your assets in which they are not actually true.
And also they're saying, hypothetically, oh, we can get you a 15% rate of return guaranteed on a regular basis, and maybe they're going to show you a certificate or something like that.
Yeah, and that's what Bernie Madoff was doing, but he was actually, we don't make the big returns. We just do 8%. And, the banks, everyone was buying into this. He's like, we're not the big, hedge funds. We just do a steady.
So he was selling to investment companies. He was selling to everyone, not your next door neighbor, but he was selling to everyone.
Yeah, big banks, everywhere. Yeah. And, a lot of people don't realize that he helped write a lot of, the laws that we actually work under in some capacities in the securities world. So it's interesting that he was involved on that end and knew the fraud, how to do it. The one thing I find about Ponzi schemes is that in a positive market, it's easier to hide.
As returns are, everything's doing well. And
right. It was in the big crashes that Ponzi schemes show their face.
When everything's going well, nobody's paying that close of attention, right? But when they start to see a market correction and investors start to go to, where do I have my money and how do I safeguard some of my money, and start divesting and taking some of that money off the table and putting it into savings accounts or whatever they think is more secure possibly. But anyways, when it starts to unwind, well, then that's when it exposes the Ponzi schemes, because typically the Ponzi schemes are relying on an influx of people putting more money into the program. When it starts to go away, then they have no way of having liquidity. And so they get exposed.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now back to Money on Tap with Ben Brayshaw, John Ryder, and Seth Cressman.
Welcome back. You're listening to Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook, 3D Investing. We've been talking about being better prepared for market drops. And pretty much what we're diving into is diversification topic. That's where we're headed. That's what we're talking about. We're talking about the conversations that we come around these experiences with pullbacks in the market. It's not uncommon. This happens with regularity. The most recent one was a huge stretch of time, record-setting stretch of time. I think it was 445 days. I had to take a quick peek just to make sure I wasn't misquoting there. But that was the longest run in history before we've had seen a 3% correction in the market. So it's new to us in recent history. And so that a lot of the time our reactions to these, the fight or flight reactions as an investor, can be a little hard to hold on to. And so we're kind of calming our nerves down a little bit. I'm drinking some coffee, so I'm not as calm as Ben and John. But they're doing a great job moving through the topic and having some fun with this piece. And also just wanted to point out that diversification is a great topic. It's something that we talk about all the time, and we're going to move into some of the different ways that we diversify, because it isn't always what people think, especially in our planning world.
That's a great point, and I think that we don't do that well on this show sometimes, is where we say, hey, we people do come into our office and they are diversified. it doesn't necessarily mean that they're diversified as well as they could be, or that they haven't done any diversification, because everyone comes in with usually,
some level.
I mean, if you go from owning one stock to two stocks, you're diversified between two stocks.
50% more diversified for sure.
Sure. Most people seem to at least come in with like the target date fund. I mean, most people have some kind of a 401k or an IRA qualified account out there where it's like they bought the one fund. I want to retire in 2040 or 2030, and there is a diversification. There is a model of diversification that transitions through those windows of accumulation for people, is technically what they're supposed to do. But at least you're right. That would be one example, right?
Yeah, and so I think people do have a general amount of diversification. I think sometimes what they don't understand is what I would classify as a balanced diversification. A
personalized diversification,
an intentional, a kind of diversification that says, this is who I am. I'm Joe, or I'm Victoria, and whatever. And this is what I want out of life. This is where my risk is. This is what I want to accomplish. This is kind of what I can sustain. People don't understand that individualized planning helps bring about really strong diversification, solid, intentional diversification that can make a significant difference in what your expectations are. And even like with this flash crash, there's people out there that are not suffering at all. There's people that are not worried about it whatsoever at all. And I think, they understand where they're at, and they're fine with that level of, if they lost 10% in the last couple of days, they're probably, those people are probably like, well, that's fine. If you're sitting there saying, oh my gosh, what's happening? I'm going to lose all my, what are we doing? You're not in the right accounts.
We have some great tools that can just help you to understand a little bit about what we're talking about here. And you can do that on your own, actually. You can go to BrayshawFinancial.com, free risk analysis for your portfolio there. You drop in basically what do you have, and it helps you. Basically, it helps you go through a couple of questions. First of all, that identify what are you comfortable with as far as volatility. If you see 5% gone tomorrow in your portfolio, what do how are you going to react to that? And then it'll help you identify what are you lined up as right now in the portfolio that you currently hold. Are you aligned? Are you on? I mean, is that or also is that portfolio going to help you get where you want to be or where you need to be by day, call it year 20?
It's right on our main page. I mean, right underneath our title and a little tidbit about our company, right on there, it's a free portfolio risk analysis, and that will by a third party, it breaks down all the information. It's a very interesting tool to evaluate what you have. It's not something that's it's just, it gives you a perspective that you couldn't have had in other formats. Compared to people in 2008 said, I never understood the risk I really owned. And now they do, and they're a little bit more cautious and a little bit more reactionary, which is what I think is happening right now. And I'd like to talk a little bit about those fundamentals, too, when you guys are ready.
I'm ready.
Well, John, you and I were talking about it. I mean, we've got basically over 80% of companies have hit their numbers.
Sure.
That's a big deal. I mean, that's not a common earnings scenario.
Not what we used to be saying years ago.
Yeah. I mean, and their projections are strong. The company's not only saying, hey, we hit our earnings, but we're expecting things to continue moving forward. And that is usually the case. But even if they think they're going to drop, they say, well, this is what our earnings are going to be. And that's a sincere, that perspective. Companies do not want to miss their earnings. So having an 80% hit is a huge number.
Well, you think about the economy across a whole, as we talked about at the top of the hour, we're talking about how jobs are up, wages are up, taxes are down, earnings for companies across the board doing very, very well. I even wanted to maybe bring in a little piece about talking about some of the United States' biggest companies out there, from Apple to Goldman Sachs, talking about the opportunities for repatriation. Ben, we had talked about this before, with Apple having $253 billion that they're bringing back into the country. They don't want to pay those exorbitant taxes overseas. Trump just lowered the taxes locally here in the U.S., so they're going to bring that money back.
Yeah, so in that one article, we referenced this in another show too, but that was really strong. I mean, Apple's bringing over $250 billion, B as in boy, into this country. It's going to cost them $38 billion in taxes. Now, They've just been sitting on that money outside the United States. We gave them a reason to bring it back, which they wanted to do, and now they're going to spend that money here. I think they're going to spend that money in the United States. They're going to spend that on buildings,
Factories,
infrastructures,
salaries,
jobs, salaries. There's a ton of tax dollars going to come, a ton of jobs that are going to come. This is going to send. This kind of action, which they are not alone in, is really going to boost our economy.
Okay, so we're seeing that with Apple. We're seeing that with Citigroup. In fact, the CEO, Michael Corbett of Citigroup, just said tax reform is a clear net positive. Citigroup is reporting an $18 billion quarterly toss on Tuesday after paying $22 billion in repatriation taxes. Goldman Sachs, same way. They're seeing opportunities to repatriate dollars and to bring them back into the country. Bank of America, American Express, J.P. Morgan Chase, all of those financial companies.
Yeah, I mean that's huge. I mean, we talk about if other countries are investing in our economy, that strengthens our economy. We go and sell our treasuries to China and all different countries all over the world. Hey, we just increased our deficit. We got to go sell those bonds. Those are things. But if money's coming back into the U.S., that's where our economy gets a boost from. And I know ultimately, hey, we're increasing our deficit. We're taking on that risk and the idea that our economy is going to grow. Our GDP will create more jobs, create more taxes, more revenues for the government in general. And that by ultimately lowering that, we get this kind of Reagan experience. I truly hope that happens. I really do. I mean, there's chances that it couldn't happen either. There's all those arguments that are back and forth on that stuff. But I think the one thing that puts this in perspective, and I know you guys have heard me share this, when we think about things like how is this going to happen both on an individual scale and how does that tie in globally, I think one of the best examples is the child tax credit. The child tax credit went from what was it, $1,250, I think it was, to now it's $2,000. Well, that's a great move for us. But a lot of the times people couldn't actually get any benefit from it. It phased out at like just over $100,000. So if you had a husband and wife who were working really hard, and they pulled in over $100,000 combined, they would phase out of that very quickly and not get any benefit. And they have 3 kids.
So it looks like a great benefit, but it's not when it boils down to it.
And it hasn't been a strong benefit. And that was one of the arguments. What was the senator? Blanking on his name. Anyways, he pushed for $2,000 per person. Now, if you have 3 kids, that's $6,000. John, you got 3 kids.
I do.
Seth, you got 3 kids.
I do.
And Ben, you have beat us all with 4.
Yeah.
I don't know. I always hear Ben wants more too. I don't know. Every time tax season comes around, there's a tax benefit. Ben wants more kids. I don't know what it is.
That was a race I didn't want to win. But so 3 kids, $2,000 per child tax credit, not deduction, tax credit.
Okay, so you're talking $6,000.
That's talking $6,000. The equivalent difference, okay? Let's say you're a charitably minded person. You're listening to this show.
Yep.
The equivalent difference to that tax credit for $6,000 would be as if you went to a church or an organization, nonprofit, Special Olympics, you name it, and you gave $24,000 and you were in the 25% tax bracket. That would be the same deal.
That's the same bang for the buck, right? Yeah.
Same bang.
Wow.
Yeah. That puts it into perspective, doesn't it?
Right. It does. And then you multiply that because now the thing is, the reason that's applicable, right, is because it's not the fact that they went from $1,250 to $2,000 per person. It's the fact that they went from $110,000 or $115,000 phase-out limit to $443,000 phase-out limit.
Much higher. Much more chance of that happening.
Which just included like 80-90% of America. That's not the super wealthy.
Right.
That includes all of middle America, which is what they were trying to capture. So it does include some wealthy people, but it's not the Warren Buffetts aren't collecting this. This is the 80-90% because the super wealthy are the top, 2 to 5%.
Sure.
So,
or the 1%, the top 1%.
Top 1%, right?
Yeah.
So when you really break it down, this is all those people collecting $4,000 to $6,000 in tax savings. That's a vacation. Our national credit card debt average is about $8,000. I think is what I heard was the last report. That might pay off most of someone's credit card debt and make them more solvent. But they could go buy something or invest in a retirement plan or.
As opposed to losing money, making money.
Yeah, contribute to a Roth, or increase a contribution to a 401k. This investment back into our people will somehow, some way, pour back into our economy and so many things. So you take John, this repatriation opportunity. You take things like the simple child, care credit, child tax credit, and you take things like lowering, and we're not even talking about the tax brackets that dropped.
You start combining these things together, and you all of a sudden have some money you're talking about.
Each one of them is a ripple. Together, this is more than a wave. This is like a tidal wave in an economy. We have fundamentals that are strong, meaning that companies are hitting their earnings numbers. We don't have institutional organizations selling off right now. We have huge tax revenues going to be coming. When those tax revenues are really going to be seen in 2019, tax cuts happen now, but we don't really appreciate those until as the year goes on. In April, hey, I get a tax refund, or how. So 2019 is when we're going to start seeing some of those real dollars hit. We've got some time here. We have so much money and so much opportunity and growth. And
so Ben, I get the idea that you're sounding very, very bullish about the tax cut, which I think a lot of us are. However, if you look at there's some downsides to it too, if you think about it. Now, I love the idea with tax cuts. I love all that, but there is something that we added on to make this tax cut happen, and that was what? That was our national debt, which I know we've been talking about on the show here as the national debt just keeps on growing. We added another $1 trillion on. And I think Ben could probably go into his $1 trillion illustration here to see how much $1 trillion is, and it's a lot. But
You're
there's a
350 million light years away from your destination.
But we're going to be paying for this tax cut down the road, aren't we? And the question is, with the national debt, what's going to happen with that? How's that going to affect all the different things that we have out there, from Social Security to Medicare, Medicaid, just a lot of issues that we have out there.
This is the gamble, right? This is the gamble our economy is making. And the gamble is that if we lower taxes, we increase the money into our country. We get more money into our country by the one-time repatriation opportunity. And we start really investing in our country, that we should be growing at such a pace that we would not only overcover that $1 trillion, but continue to decrease that
and to
scenario.
pay that down over time.
But that gamble is going to take more than 12 months to happen.
Sure.
Right? We're not going to see. So when re-election happens, that's when we're really going to start seeing our economy move, which is interesting because the success of this hopefully will be seen inside the next 3 years in order for it to continue. Because if this works, which mathematically it's supposed to work, but not everything's perfect in our economy, right? I mean, because at the end of the day, we're affected by China. We're affected if North Korea launches a nuclear bomb. Our economy, our whole world is affected by more than just what we do.
It's more than the sum of its parts, for sure.
Exactly. We need to take those things into account, but our previous trajectory was not the right one because we weren't fixing that. So we need to make a step one way or another, and all of them are a gamble.
This just yesterday, I got a call from a wholesaler. That's one of the ways that some of our products move in and out of our industry. But the conversation actually was a voicemail that was interesting. Was about this pullback in the market and being prepared and downside protection, and all these words that we're kind of familiar with. And my thought was with that is for one, I get it. You gotta make those calls. That's what they have to do. And B, these are the conversations that we have on a regular, ongoing basis. And so that by the time that we see changes in the marketplace happen, we have already had these conversations, and we're prepared, and you're prepared. If you haven't had this thought, if you haven't had this conversation and understanding, what do you need to do to be prepared? Those are exactly what we're here for. And that's exactly why we're having this conversation now. One of the things we wanted to talk a little bit about was being active versus passive, and how does that work in a portfolio?
Yeah, Seth, as we're talking about this, and I think we probably need to touch on this in another show. But it's funny, Mr. Wonderful
from the Shark Tank. Yeah, for a minute I thought you were talking about the wrestler.
Talking about you.
Okay.
I wasn't talking about you, John.
Okay. It's confusing.
I thought it was the professional wrestler.
No, he was talking
80s?
about how he was convinced to invest in actively.
This is Kevin O'Leary, Shark Tank,
O'Leary. Actively ETFs, actively traded ETFs, and actively managed. And so I think what's interesting is that we have been riding this bull market for a long time, and passive. Everyone's talking passive, low fee, and we do that. Like we do that in waves. But there is a time and place for everything. And I think a better perspective of this is that there's a time for passive and there's time for active. And, as we ride a bull market and you start nearing what is, hey, we're doing really well here. When you start saying that and you start saying, hey, listen, I think we got a long-term kind of deal here, that's when you really want to put some active, some tactical, somebody looking over your portfolio saying, listen, let's protect some of those losses. Let's look at how to handle that.
You mean not just rolling over and taking whatever comes along,
right? When the market drops and you have fundamentals that are strong like this, if we had a bigger drop, it'd be like, hey, listen, get into some passive holdings. That might make a lot of sense for you because we don't have a lot more to lose.
As investment advisors, we have a barrage of emails coming to us constantly, especially when we see large market drops. But we're seeing everyone that is communicating to us are talking about the possibilities of buying opportunities. I saw an interesting quote the other day by a guy named Lawrence Peter. It's called Maxims of Wall Street is where it comes from. But he says this: many an optimist has become rich simply by buying out a pessimist. Interesting. Many an optimist has become rich simply by buying out a pessimist.
Yeah, every stock that you're selling or somebody's selling,
someone's buying.
Somebody else is buying it. And that's the truth. Someone thinks it's a good deal. Someone thinks they've made all their money they're going to make in this thing.
Yep.
You've been listening to Money on Tap, and we've been talking about being prepared for these market drops. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Hopefully, you got a little something out of this. You got a little more prepared. You have a conversation that you can bring back to the kitchen table and start thinking about, hey, how prepared are we for moving towards the latter part of this bull run? And maybe there's some ongoing conversations. Maybe there's some off. How do we get off of this track of being just completely invested in the market in a passive way? Being a little more prepared. Either way, we hope we brought some conversations to the kitchen table today that you're able to have. We look forward to having those conversations with you. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.